Welcome back, everyone, to the channel, the Millennial Messiah, and we are going to continue reading from the Lords of Easy Money, and we are on Chapter 9, The Risk Machine. Some of the most profitable products created by Rexnord were not created on the company's factory floors. They were created hundreds of miles away in a stately skyscraper with vaulted archways over its entryways, located at the corner of Madison Avenue and 25th Street in the heart of Manhattan, New York City. This is where Robert Hetu arrived very early in the morning on most workdays, so he could get a jump on his day as a managing director at Credit Suisse. He worked in the division that created and sold leveraged loans, many of them originating from Rexnord's headquarters in Milwaukee. Rexnord might have been an obscured company that occupied old factories in shabby neighborhoods, but it provided a fountain of prosperous work for the debt engineers on Wall Street. Hetu's office overlooked Madison Square Park, but everyone was working too hard by the middle of the morning to enjoy the view. The private offices for managing directors like Hetu were arranged around a central pen of cubicles, staffed by an overworked team of junior analysts and associates. Hetu had been one of these associates years earlier and even grown accustomed to the grinding pressure of the job. It was a 7 days a week endeavor, and not in the metaphorical sense that the job was always hanging over you. The junior employees were at work literally every day, sometimes even for years on end, making frantic phone calls on Sunday afternoons to finalize the details on a bond issue or a leveraged loan. Even after Hetu was promoted to managing director, he arrived at the office around 7 in the morning and left at 7 in the evening, giving him a couple of hours to see his kids before they went to bed, which was then and when he started working the phones again. Hetu took a vacation once to a luxury resort in Shangri-La, China, where he joined his family on a tour van to see the countryside. However, ended up on his cell phone in meetings with a lawyer. He remembered the van stopping to let a bunch of pigs cross the road while he negotiated over the phone. That's the lifestyle. You'll get rewarded for it, but there's a price to it, Hetu recalled. The incentive to live this life was obvious. A single managing director at Credit Suisse could generate tens of millions of dollars worth of fees in a year for the bank and take home a cut of the money. There was never a shortage of fees to earn, because the world of corporate debt was an ever turning wheel of new loans that replaced old loans as the debt was rolled over again and again. When Apollo had bought Rexnord, for example, it borrowed the money through leveraged loans that it rolled over repeatedly. Each refinancing generated fees for Credit Suisse. The benefit to Rexnord was keeping its debt afloat at a relatively low interest rate. This was why people like Hetu were on the phone all the time, usually with lawyers. Hetu helped Rexnord refinance $1 billion in debt in March 2012, and the contract for the deal was 344 pages long. Virtually all of the paragraphs in those 344 pages were produced under heavy scrutiny, negotiation, and anxiety. A successful debt contract contained a multitude of components that had to fit together snugly, immune from legal challenge in such a way that it would entice outside investors to buy the debt. Selling the debt was crucial for the business model to work. Credit Suisse arranged the leveraged loans, but never meant to keep a lot of them. They're not in the storage business. They're in the moving business, Hetu said. The moving business was usually brisk. Hetu and his team arranged debt deals, then syndicated the loans and sold them to institutional investors like pension funds. This was still something of a niche business in 2006 when Apollo bought Rexnord. The big investors, like pension funds or insurance companies, shied away from buying leveraged loans because they were considered somewhat opaque and risky. This changed in 2010 when the Federal Reserve began its second round of quantitative easing and kept interest rates pinned at zero. When the Fed pumped trillions of dollars into the banking system and harshly disciplined anybody who tried to save it, the cash was forced toward the offices of Credit Suisse. Hetu saw the change clearly. There was so much cash and so few places for that cash to go. With more capital that's available, then you've got to find product, Hetu said. The product, in this case, was a company like Rexnord that was willing to take on more debt. In America, the supply of such companies seemed almost limitless. If entrepreneurial optimism was America's greatest resource, then the leveraged loan market was harvesting it, providing debt to anyone who could dream up a way to spend it. There was, however, a natural limit to this system, and it was in the banking system's tolerance for risk. Credit Suisse was in the moving business. It didn't want to keep leveraged loans on its books as much as it wanted to reap the fees from selling the loans. Credit Suisse needed a supply of outside buyers if it wanted to expand its business. When the tidal wave of QE cash arrived on Wall Street, it created new openings for banks like Credit Suisse, an opening that would expand their leveraged loan business to an unprecedented scale. This would be made possible by something called the Collateralized Loan Obligation, or CLO for short. This name, CLO, might sound familiar to big fans of the 2008 financial crisis. In 2008, the market imploded thanks to an exotic debt product called the Collateralized Debt Obligation, or CDO. The CDO was a package of home loans or derivative contracts based on home loans stacked together and sold to investors. The CDO made the housing market crash possible by creating a seamless assembly line that allowed mortgage brokers to create risky subprime home loans that were quickly packaged and sold to investors, which in turn allowed the mortgage brokers to extend yet more new loans. At that time, the lowly CLO was the undernoticed stepchild of the debt markets. There were only about 300 billion worth of CLOs during the global financial crisis of 2008, while in 2006 alone, about 1.1 trillion of new CDOs were issued. But the important thing about CLOs was that they didn't suffer nearly the losses that CDOs suffered. When Wall Street emerged from the rubble of the crash around 2010, CLOs gained a reputation as relatively safe investments. Credit Suisse was a leading producer of CLOs. It produced 11 between 2010 and the first half of 2014, worth a total of 6.7 billion, making it the third largest CLO dealer in the country. Robert had too found himself at the epicenter of this new debt assembly machine. He and his team had deep expertise in arranging new leveraged loans, which they could then sell to CLO managers. The barrier to making new leveraged loans had been broken down, but there was another Credit Suisse executive who was crucial to breaking down that barrier. That's because it wasn't just the size and volume of the CLO machine that made it so important. It was also the way the deals were structured. Leveraged loans were once the domain of private equity firms like Carlyle and Apollo, which were comfortable with the complicated and non-standardized terms set out in a 344-page debt deal. The CLO made leveraged loans an off-the-shelf chain store product, and that was thanks to people like John Popp, the head of Credit Suisse's CLO unit. Popp looks like a trustworthy guy. He wears the pinstripe suit uniform of any good banker. He has close-cut gray hair and a cherubic smile that highlights high cheekbones. In May 2012, Popp put out a document that was basically an invitation for people to pour their retirement savings into CLOs. The document was called White Paper, and it was published by Credit Suisse's Credit Investment Group. The White Paper addressed a vexing problem faced by conservative institutional investors. How were they supposed to earn a yield on their pools of cash when the Fed kept interest rates pinned at zero? This was a matter of survival for pension funds and insurance companies. In a 0% world, these companies were suddenly underfunded. They had been counting on interest rates to pay a certain amount of money every year, because that's how things had been for decades. Popp was sensitive to this problem. His paper began with a question posted somewhat plaintively. What can investors do when real yields on a 10-year treasury are negative? Luckily, Popp had a solution to the dilemma. His paper politely suggested that institutional investors consider investing in a type of debt that was once seen as too arcane and opaque, like leveraged loans. If investors were willing to take on a little more risk, they could explore the middle tier varieties of corporate debt, which paid about 4.4% in interest, compared to a yield of 1.2% interest on the safest kinds of corporate debt. The riskiest corporate loans yield around 5.6%. The pension fund had been settling on a low return from safe corporate bonds because those bonds were standardized like a Model T Ford. The bonds were regulated by the SEC and traded on exchanges. People understood them. Leveraged loans, however, were very complicated contracts with terms that could widely vary and weren't overseen by a regulator in the same manner as stocks and bonds. The CLO solved this problem. It would standardize leveraged loans in ways that made the pension fund feel safe. The key innovation of CLOs was how they standardized the leveraged loans inside them. A CLO divided its loans into three big chunks, divided by risk. The riskiness of the three groups was determined by where the owner stood in line when it came time to collect the interest payments made by all the borrowers. The first group was the safest and rated with a AAA label. People who owned these AAA loans were the ones to be paid first by the borrowers, and the owners would be the first in line to get their money back if the underlying loans went bust. These AAA investors could sleep easy, but their chunks of the CLO paid the small interest rates because they were so safe. Investors who had a higher appetite for risk could buy the next chunk of the CLO, which was the second riskiest group, called the mezzanine group. People who owned these loans got paid second, and they stood in line behind the AAA people to collect their money if the loans went bad, meaning that they might not get all of their money back. Because of this risk, they got paid a higher interest rate. Finally, there was the third and riskiest chunk of the CLO called the equity chunk. Equity owners got paid last, and if the loans failed, they might be wiped out entirely. This meant that a pension fund could order CLO chunks like someone ordering a meal at McDonald's, picking between the AAA, mezzanine, and equity slices of the package. This opened a new pipeline for Robert Hetu and his team of leveraged loan makers. The proliferation of CLOs at Credit Suisse and elsewhere created the steady buyer they had been looking for. Rexnord's debt was chopped up and distributed into a wide variety of funds that were offered by Pop's division. The buyers came storming into Credit Suisse's CLO shop, desperately searching for yield. The Rexnord debt, which was still rated as junk debt, meaning the big credit rating agencies believed that the debt was so risky that it was below investment grade, was sliced and split like cord wood, and then stacked into a wide variety of funds that were sold to investors. Rexnord debt ended up in Credit Suisse's offerings with names like the Credit Suisse High Yield Bond Fund, the Credit Suisse Asset Management Income Fund, and the Credit Suisse Floating Rate High Income Fund. All of these funds contain debt from numerous corporations that, like Rexnord, had taken out heavy loans of leveraged loans and issued corporate bonds. The majority of CLOs were owned by big institutional investors like insurance companies, mutual funds, and banks. Rexnord's debt, for example, ended up in the portfolio of state employee pension funds that paid the retirement incomes of government workers in South Carolina, Pennsylvania, and Kentucky. Rexnord debt was even snapped up by the giant investment firm Franklin Templeton, which managed mutual funds and retirement accounts. The CLO helped create more leveraged loans than ever, while dispersing them more broadly than ever throughout the financial system. These loans had one key attribute that made them safe for investors, but more risky for the borrowers, like Rexnord. Leveraged loans very often carried variable rates, meaning that the interest rate on the loan could change before the loan was due. This protected investors if rates went up because it shifted more of the risk onto the borrower. If rates rose, the borrower's interest payments increased significantly. None of this seemed like a problem during the years of ZIRP because rates were kept so low. Credit Suzy helped Rexnord roll its debt in multiple times, keeping the company one step ahead of the day when it needed to repay the full amount. The rates remained low for Rexnord, and Credit Suzy earned fees on each refinancing. This was the case all across Wall Street. Global investment banking fees rose steadily as QE money was pouring into the financial system, hitting a monthly peak of 1.1 billion in June 2014, surpassing the previous record of 10.7 billion set in the summer of 2007 right before the crash. This was around this time in 2014 that a junk bond analyst named Vicki Bryant noticed a pivotal change in the market for corporate debt. Old rules of junk debt and leveraged loans didn't seem to apply anymore. The market became disjointed completely from economic reality, Bryant recalled. Her job as a junk bond analyst was to hunt for fraud or incompetence at the companies that borrowed junk debt and then warn her clients about it. Her entire business model relied on the fact that when analysts released important information, it affected the market. When Brian exposed wrongdoing at the company, her clients who owned the company's risky debt could sell it, or at least demand a higher interest rate for the risk of owning it. That's how Brian worked until the dawn of ZIRP, which fundamentally altered the dynamics of corporate debt markets around 2014 or 2015. Brian noticed that she could bring on new revelations to the market, but it didn't seem to matter anymore. It's been a result of what the Fed started to do in 2010 and continued to do later, she said. You've got an artificial bottom, and the higher part of that bottom is set by the Fed. So you can't lose in this market. And if you can't lose, it's not really a market, Brian said. All that money, believing that it could not lose, began to pour into the new market for leveraged loans and CLOs. At the end of 2010, there had been a little less than 300 billion worth of CLOs in the United States. But by the end of 2014, there were 400 billion. By 2018, there would be 617 billion. This was and created a lot of work for people like Robert Hetu at Credit Suzy. There was too much cash chasing every leveraged loan that the banks could sell. Hetu could see what this was doing. More loans were getting sold, and investors were willing to accept more risk with each passing year. Hetu described the situation as being caught in a vice. On the one side, there was pressure from investors like pension funds clamoring for loans. On the other side, there were the private equity companies like the Carlyle Group, which were the best source of these new loans. The private equity firms had leverage and they began to use it to their benefit. A typical leverage loan was born when a private equity firm like the Carlyle Group landed a deal to buy a company like Rexnord. The private equity companies were the original fountain of eternal debt and were known as the sponsors of the loans on Wall Street. After Carlyle sponsored a deal, it approached a bank like Credit Suisse and offered the bank a chance to fund the deal by arranging a group of investors to contribute the money. Hatu was this middleman at the bank, and he was often dependent on the sponsors for his flow of leverage loans. Over time, the sponsors became more demanding. They knew banks were desperate to secure more leveraged loans. The sponsors sometimes flexed their muscles in irritating ways, like insisting that they could choose which law firm Credit Suisse hired to oversee a deal. However, Hatu didn't like that the sponsors were dictating which lawyer he could use, and he suspected that the sponsored selected lawyers would probably be sympathetic to the sponsor when they looked over the paperwork. But what could he do? The companies like Carlyle had the upper hand. The sponsors exerted their bargaining power in more important and worrisome ways. They started to offer leveraged loans for sale that had very loose covenants, meaning the contract terms that protected investors. A typical covenant might dictate that a borrower like Rexnord couldn't immediately go out and take on more debt. That made it harder to pay back on its earlier loans. Or a covenant might say that a borrower needed to get permission from their lender before selling off assets. These kinds of covenants had always been in common, but the leveraged loans sponsors started insisting that they be cut. Eventually, the sponsors got so bold that they started sending lists of detailed loan terms, maybe 20 pages long, insisting that they be included in the deal, Hatu recalled. These terms gave the borrowers more flexibility and stripped out covenants that protected the investors. This became so common that Wall Street came up with the nickname for loans with the covenants stripped out, calling them Cove Light Covenants. It became Hatu's job to take the Cove Light loans out of the market and to see if anyone would buy them. He would sometimes insist to the sponsor that if he couldn't find a buyer, he would add covenants back in to protect investors. But he didn't need to. There was always a buyer. A $1 billion loan would have $2 billion worth of takers. This happened repeatedly. The demand for Cove Light loans were intense, which was only encouraged the ideal sponsors to insist upon them more. There was just too much money looking for yield for investors to demand high standards. It's tough. You see what people agree to, and you're like, oh my goodness. Do you realize what you're agreeing to? Hatu said. These deals get more and more aggressive by the day because the market, again, is supplied with a lot of cash. The CLOs have to put money to work. There is a limited number of deals that are coming to the market. They all love it. They all buy it. Hatu was aware of the risks inherent in the leveraged loan business. He also knew that there were benefits. The loans went to companies across the country, and gave them credit that they could use to expand, hire workers, or invent new products. And bundling the loans into CLOs could help mitigate the risks for investors by diversifying their exposure and limiting their losses if a handful of loans went bad. The institutional investors who bought the CLOs were sophisticated, and they knew what they were doing when they bought into the Cov Light market. The Cov Light loan, once an exotic debt instrument, became the industry standard. In 2010, they accounted for less than 10% of the leveraged loan market. By 2013, they were over 50%, and by 2019, they accounted for almost 85% of all leveraged loans. Even through the looser covenants took away protections for investors, demand for such loans still grew stronger, and the competition to issue them grew more intense. Carlyle and other private equity firms like Apollo, Bain Capital, and KKR even started their own loan divisions to meet demand, creating and managing CLOs of their own rather than relying on banks like Credit Suisse. The appetite for CLO was large in part because the debt packages had performed so well during the crisis of 2008, retaining their value as other credit products cratered. Bankers and private equity firms weren't the only companies competing to issue corporate debt. They were joined by a once obscured type of investment firm called a Business Development Corporation, or BDC, which had been created by Congress in the 1980s. The BDC got a tax break to lend money to small businesses that were so risky that they couldn't get a traditional bank loan. The BDC launched these loans together and sold them to investors who could buy pieces of a BDC on the public stock exchange. BDCs had operated in a quiet corner of finance for decades, issuing loans to mid-sized bakeries, medical device makers, or food companies. Most of the loans carried super high interest rates after 2010. The amount of money under management by BDCs exploded. There were about 40 BDCs managing 27 billion of risky debt. In 2010, by 2014, there were 77 of them managing 82 billion. By 2018, some 95 BDCs were managing 100 billion in assets. The rush to expand, package, and sell corporate debt was unstoppable. Corporate borrowing rose to record levels in the United States. At the end of 2010, the debt of total non-financial companies was 6 trillion. That became 7 trillion by the end of 2013, almost 9 trillion by the end of 2017, and 10 trillion by 2019. The rise in corporate debt embedded a deep set of risks within the financial system of America. This risk was double-sided, with borrowers on one side and lenders on the other side. The lenders or investors held more risk because all those covenants that were discarded over the years. If borrowers defaulted, the investors were less protected than ever before. As for the borrowers, they faced a different kind of risk. When all those companies took on loans or issued bonds, they committed themselves to surviving on the roll. They depended on the ability to roll over the debt at a decent price before it expired, and they had to pay off the full amount. This worked fine as long as the Fed helped to suppress interest rates and keep the financial system afloat on the new money. But if money was withdrawn or interest rates crept higher, the cascading effects would be shattering. Companies would have to pay off the debt or accept much higher interest rate costs. Defaults would spell more losses for investors. Had Tu watched this all unfold, and he noticed the same thing that Vicky Bryan noticed. No one in the world of CLOs or leveraged loans seemed to think they could lose. A 27-year-old CLO loan manager in 2018 would have been only 17 years old during the financial crisis. They are portfolio managers in CLOs today that were kids in 2009. They don't have the experience of dealing with a very tough cycle, Hetu said. Investors were buying loans that they knew were crummy, but they had to operate on the belief that they could sell them when they needed to. Well, the problem is when things don't go well, the markets freeze and you can't sell. It would be easy, years later, to point fingers at the Wall Street deal makers who built and financed these towers of risky corporate debt, but the financiers were only doing what the Federal Reserve gave them the incentive to do. None of this should have been surprising to senior leaders at the Fed. In 2013, while the FOMC was overseeing its largest round of quantitative easing yet, the Dallas Fed president, Richard Fisher, explicitly pointed out that the policy would primarily benefit private equity firms like Jay Powell's former employer, the Carlyle Group. Fisher challenged the theory that this would create the wealth effect Bernanke hoped for, as higher asset prices translated into more pay and more jobs for working people. It has, I believe, had a wealth effect, but principally for the rich and the quick, the Buffetts, the KKRs, the Carlyles, the Goldman Sachses, the Powells, maybe the Fishers, those who can borrow money for nothing and drive bonds and stocks and property higher in price, and profit goes to their pockets, Fisher said during a meeting. He argued that this was not going to create jobs or boost wages to nearly the degree that the Fed had hoped for. That, of course, would depend largely on how the companies spent all of that borrowed money. Rexnord, for example, borrowed billions of dollars through multiple rounds of debt refinancing underwritten by Credit Suisse. What had happened at Rexnord would illustrate exactly how much the cheap debt would reshape the fate of most workers. And we know from chapter 8 that they actually fired people at Rexnord because of this. Anyways, that was the end of the chapter, so we are going to leave off there, and in the next video we will do chapter 10, the ZERP regime, and I hope you all enjoyed listening. If you have any comments or questions, please let us know in the comment section below, and have a good rest of your day. Bye.